Thank you for watching. Please like and subscribe to our channel.
All right, welcome to this explainer. Look, if you've been following the financial news lately, you're probably suffering from some serious whiplash. But today, we're cutting through all that noise. We're going to look directly at the hard data to see exactly where the smart money is moving to demystify all this crazy market volatility. So let's just dive right into this massive paradox. I mean, you read the headlines, right? Tech stocks are supposedly in total freefall. But then you look at a number like $119.2 billion. That exact record-breaking amount just flowed into U.S. stocks in a single week, the largest weekly inflow we've ever seen. So how on earth is tech crashing while a historic mountain of cash is just pouring into the market? Well, the money isn't disappearing, it's relocating. And finding out exactly where it's going, that is how you uncover the hidden opportunities in this market cycle. To solve this financial mystery together, we're going to quickly cover the Great Tech Paradox, tracking the smart money, AI's unlikely infrastructure boom, changing consumer tech trends, and finally, the contrarian investor playbook. Starting off with Section 1, the Great Tech Paradox. Let's look at the macro picture here, where completely contradictory headlines are leaving everyday investors totally confused. Global tech indices are dropping right now, mostly because of uncertainty around the Fed's next moves and some new geopolitical optimism. But Wall Street, they're insisting this is absolutely nothing to panic over. Actually, Wedbush Securities is literally calling this tech sell-off a, quote, healthy pullback inside the larger AI boom. But, you gotta ask, healthy for who? Because for the everyday investor loaded up on speculative software, it definitely doesn't feel very healthy. But for the giant institutional investors just waiting to buy value at a steep discount, this volatility is exactly what they've been waiting for. And this dynamic perfectly illustrates what we call the mega rotation. The market is basically bifurcating right before our eyes. On one side, you see what people are dumping: overvalued AI software companies with zero clear path to making a profit, and hype-driven consumer tech that's suddenly facing a ton of regulatory pressure. But on the other side, we see where that $119 billion is actually landing. The buyers are targeting the picks and shovels: hard AI infrastructure, raw commodities, and totally overlooked value plays like corporate spinoffs. The smart money is rotating out of the clouds and coming right back down to earth. Moving on to Section 2, tracking the smart money. Let's actually look at the portfolios of market insiders to see this rotation happening in real time. What's absolutely fascinating here is just how contrarian these superinvestor trades are right now. When we track legendary funds, places like Greenlight and Maverick Capital, they are absolutely not chasing those shiny new software IPOs. Look at what they're actually buying. They're loading up on battered consumer brands, adding massively to positions in places like Peloton, and scooping up McDonald's. At the same time, they're aggressively dumping previous market darlings like Disney and Roblox. They are completely abandoning the crowded, hype-driven trades to find absolute value where everyone else is just too afraid to look. We're even seeing this exact same defensive maneuvering on the Congressional Trade Monitor. If you look over the last 30 days, it's all about quiet, targeted exits. Take Representative Christian Demonoff, for example. His only recent trade was quietly offloading exactly $32,500 worth of Pinterest stock. When you put the Superinvestor data and these congressional trades together, the pattern is just undeniable. Insiders are actively trimming their exposure to highly valued consumer digital platforms. But here is where it gets incredibly exciting if you're a value seeker. Because the mainstream crowd is just so utterly obsessed with AI growth, they're completely ignoring established, mature tech companies that are currently throwing off massive 8.7% dividend yields. I mean, while retail traders are out there chasing the next AI moonshot that might not see a dime of profit for a decade, the smart money is just quietly scooping up these income-generating assets that the rest of the market completely abandoned. Which brings us to Section 3, AI's unlikely infrastructure boom. So if all this money is rotating out of AI software and digital platforms, where exactly in the tech sector is it actually going? I want you to really think about this for a second. If you had to guess the absolute hottest, most in-demand asset driving the AI boom right now, what would it be? Take a mental guess. You're probably thinking it's some flashy new microchip design, right? Or maybe some crazy advanced language model. But the reality is way more elemental and, honestly, a whole lot less glamorous. The answer is tin. Yeah, literally tin. The crucial takeaway here is that old-school raw commodities have quietly become the absolute backbone of the physical AI revolution, because you simply cannot build a multi-billion-dollar AI data center without soldering the physical components together. So as this massive data center construction boom heats up globally, the demand for tin is absolutely surging. While everyday investors are out there fighting over software stocks, the insiders are just buying the basic raw materials needed to physically build the future. And this massive pivot from software to hardware, it's taking a very real human toll. Across the entire sector, major tech companies are quite literally cutting staff just to free up the cash they need to afford these physical chips and infrastructure. We are talking about hundreds of billions of dollars being radically redirected away from human capital, the people actually coding the software, straight into the raw data centers required to stay alive in this new AI arms race. All right, on to Section 4, Changing Consumer Tech Trends. Because this smart money rotation isn't just about data centers and corporate balance sheets. It's deeply connected to how our daily human behaviors and wellness trends are rapidly shifting. Consumers are going through some serious cultural whiplash right now. Just look at the trends dominating our culture. People are actively pushing back against toxic digital environments. We're seeing a massive anti-looks-maxing movement, which is basically a total rejection of that internet trend of hyper-optimizing your physical appearance. We're also seeing a huge revolt against the relentless digital hustle, like the pushback against inbox zero and forced productivity. At the exact same time, governments are stepping in, like the UK implementing landmark social media bans for users under 16. In response to all this, consumers are turning inward. They're embracing quantified physical self-care, things like intense hydration tracking and monitoring physical sweat scores during workouts, instead of just endlessly chasing digital likes. And this brilliantly highlights the fracture between the hype of technology and the reality of human well-being. People are finally waking up to the fact that our over-reliance on tech has real consequences. Studies are now showing how relying on GPS is literally ruining our natural sense of direction. And there are very real growing fears that AI is actually weakening our creativity and critical thinking skills. So what's the antidote? We're seeing a massive resurgence in incredibly simple analog wellness practices. Things as basic as just taking a 5-minute walk to boost workplace happiness or focusing on heat-safe exercises. This market rotation out of consumer software perfectly mirrors our cultural exhaustion with the digital world. Let's bring this home with Section 5, the Contrarian Investor Playbook. We're going to tie all these financial and cultural clues together to reveal exactly how the insiders are playing this market. To successfully navigate this mega rotation, you basically have to ignore the mainstream hype. First off, avoid those overhyped AI software companies that are priced for perfection but have absolutely zero real revenue. Instead, target the picks and shovels, AI infrastructure, and raw commodities like tin. Second, seek out those established tech companies offering high dividends that the growth-obsessed masses are just totally ignoring. Third, look for hidden gems in corporate spinoffs. You know, when a massive company spins off a smaller, independent business? These guys often outperform their parent companies in their first 2 years, but they almost always get dumped initially by index funds. And finally, follow the ultimate bullish signal, heavy insider buying, specifically executives who are eagerly snapping up their own company's high-yield stock. I really want to leave you with this incredibly powerful framework from Forbes. They say the most important question in investing is who has to sell. You see, the absolute greatest opportunities don't come from finding a perfect company. They come from market inefficiencies. They happen when massive institutions, index funds, or over-leveraged retail traders are forced to sell their positions, regardless of what the underlying asset is actually worth. That forced selling is exactly what allows the smart money to step in, provide liquidity, and buy up high-quality assets at a massive discount. So, look, this isn't the end of the tech boom. It's simply an evolution. As the global market aggressively shifts from speculative software to hard physical infrastructure, and from these wild growth projections to quiet, reliable dividends, you have a choice to make. Are you going to be the one caught holding the dag, endlessly chasing the old hype? Or are you going to recognize the patterns we've uncovered today, adapt your strategy, and follow the new money? The mega rotation is happening right now, whether we like it or not. The only question is, which side are you on?